For generations, gold has occupied a distinct space in the Indian household. It serves as a generational emergency fund, a physical safety net reserved for life's most difficult moments. When financial trouble arrives, the survival playbook is predictable. Families will cut daily expenses first. If that isn't enough, they drain their cash savings. Next comes standard bank loans. But handing over the family gold is different. Selling or mortgaging these assets represents a psychological line most families try desperately to avoid crossing. Yet recent nationwide data reveals a sharp shift in behavior. An incredibly high number of families are suddenly bringing their gold to lenders. This chart maps out gold loan volumes over the past several quarters. Rather than a stable baseline, we see a steep, aggressive upward trend that breaks away from historical norms. This sudden volume of borrowing against an asset of last resort indicates that the standard financial buffers for the middle class have already been exhausted. To understand why savings are depleting, we have to look at the immediate pressure on purchasing power. Inflation is steadily reducing what a single rupee can actually buy at the market. When global fuel prices fluctuate, the cost of moving goods increases. That transport premium is passed directly to the consumer, elevating the price tag on almost every basic necessity. Then there is the unpredictable nature of the monsoon season. When erratic climate patterns flood or starve agricultural regions, crop yields drop, triggering sudden spikes in food costs nationwide. Those agricultural shocks travel straight to urban centers. For city-dwelling families managing fixed budgets, paying a premium for vegetables and grains becomes a heavy daily burden. While everyday expenses climb, income is failing to keep pace. Recent employment data shows a cooling job market, with hiring rates slowing down and middle-class salaries remaining largely flat. To bridge the gap between flat paychecks and expensive groceries, people are increasingly relying on high-interest personal debt, heavily drawing down on credit cards just to maintain their standard of living. When these unsecured avenues are exhausted, families move to the final stage of their financial roadmap. This surge suggests that for many, gold loans are now filling the gap left by depleted savings and maxed-out credit. There is a sharp contrast between this everyday reality and the numbers lighting up Dalal Street, where the Indian stock market has been hitting record highs. To separate domestic market enthusiasm from the broader financial reality, economists track capital outflows, the movement of foreign investor money. This graph details the growing divergence. The domestic stock market index climbs steadily, while the bars below show a decline in foreign investment. As this gap widens, local retail investors push the market upward, but global money quietly pulls out to safer assets. When foreign capital leaves, it puts downward pressure on the value of the Indian rupee. A weaker currency means the country must pay more to import globally priced essentials, particularly crude oil. That expensive oil makes transport costlier, which increases the price of food. It is a cycle of imported inflation that lands directly on the household budget, driving families right back to the gold loan counter. Despite these severe household pressures, the broader economy retains heavy structural advantages. A massive working-age demographic and highly efficient digital public infrastructure provide a strong foundation. The current data reveals an economy under deep strain, but that is distinct from a system in collapse. The pressure points are clear, and while the economy is heavily strained, the underlying system remains intact. The Reserve Bank of India has specific tools to navigate this. By carefully adjusting interest rates, they attempt to cool down inflation without freezing corporate hiring in the process. On the fiscal side, the government faces the challenge of implementing structural reforms. The immediate focus rests on generating large-scale employment to raise baseline incomes for the middle class. For anyone watching these trends, the key metrics to monitor are the quarterly inflation reports and official hiring data. Those numbers will dictate the next phase of the recovery. Ultimately, it requires careful financial navigation for the ordinary citizen to weather these shifting economic tides and protect whatever wealth they have managed to build. The real question isn't whether challenges exist. The real question is how a nation prepares for them.